In other news, Singapore's Sovereign Wealth Fund, GIC, posted a 3.4% 20-year annualised rolling real rate of return for its latest financial year, its lowest since 2020. The investor says it took less risk and prioritised resilience, and is also positioning for the next wave of growth in areas like artificial intelligence. Beatrice Yap reports.
Resilience through diversification. That's GIC's strategy for navigating today's uncertain markets. While this provides greater protection during downturns, the trade-off is more modest gains when markets rise. Its 20-year annualized rate of return came in at 3.4%, down for the third straight year. The returns cover April 2006 to March this year, after the financial year ending 2005 was dropped.
Other countries, for sovereign wealth fund, may have oil reserve, gas reserve, so they can report quarterly, they can report annually, etc. Singapore, we don't have. So we have to make sure we earn on a consistent, sustainable basis from what we have already earned and made, and continue to grow.
He adds that GIC's lower published return does not directly affect funding for Singapore's budget, but elevated inflation in recent years means the outlook remains tough.
So it will still be challenging, and may still essentially see these low single digits real return over the next couple of years, or unless we start to see inflation drop off significantly, that we move from this higher block of 6 to 8% inflation to a lower block of 3% or below, which have been historical norm.
But as global markets become more fragmented, GIC says it also needs a more flexible investment approach. It's refreshing its strategic portfolio into 3 broad baskets: equities to drive long-term growth, fixed income to provide stable income, and real assets to strengthen resilience against inflation.
I think previously they had mandates, and they had different, more granular asset classes, and then mandates for each asset class. So they had to, accordingly, manage probably a smaller sum of capital within each asset class. And then when they want to deploy to another asset class, they might have to go through certain processes. But right now, imagine, before that you have a bucket of money, and it's sorted into many different small buckets. Now you have a bucket of money, it's sorted into 3 big buckets, and within those 3 big sub-buckets, you can deploy flexibly.
That added flexibility allows GIC to respond more quickly when opportunities emerge in different markets and sectors. By region, the Americas remains GIC's biggest destination of capital deployment. Its exposure to the region is now at its highest level since the firm began publishing annual reports in 2008.
I think it's unavoidable that large funds like GIC have to invest in America. After all, the US is still the most liquid capital market, and it also has an abundance of entrepreneurs and abundance of very good companies that are really utilizing AI to power their businesses forward. And so I think US remains, of course, naturally speaking, would remain a focus of global funds like GIC.
Much of that investment is also driven by another long-term theme: artificial intelligence. The firm has already invested in companies like Anthropic and across the value chain, from firms building AI-powered products to applications where the technology creates real economic value. GIC says the challenge next is identifying the long-term winners as AI becomes more deeply embedded across the global economy.
GIC also plans to deploy an additional $30 billion into hedge funds. Here's a look at the 3 strategies it highlighted. First, strategies built around major economic and geopolitical trends. Second, funds using mathematical models to spot trading opportunities. And third, funds that shift between strategies as opportunities change. GIC is combining hedge fund strategies with its stock and bond investments to better balance risk and returns. Analysts say this could help seize opportunities across volatile markets.
Matching a short hedge fund with long equity positions so that they have the ability to sort of neutralize certain risk or take certain views on certain types of sectors or industry. Or it could be pairing hedge fund that has a very non-correlated to the market kind of strategy alongside equity position so that they can diversify their source of return.